It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today, we're scoping out the financial landscape via exchange operator. So what's the best way to play it? I'm here with Yuri Khodjamirian. He is Tema ETF's Chief Investment Officer. Yuri, thank you so much for being here.
Thanks for having me.
So we have not yet talked about exchanges on Goodbye or Goodbye, so this is a good one to dig into. And let's start with the stock that you do like, and that is Intercontinental Exchange, also known as ICE. The shares have gone up pretty much over the past 6 months or so after being flattish for the prior 6 months. So let's go through your case. First of all, it's not just an exchange operator, right? They're a data provider, and they also just made an acquisition, a company called Black Knight, that will help them expand into the mortgage market. Talk to us about why that's attractive.
Yeah, absolutely. I mean, look, financial exchanges, they're all about data. They're about understanding how, the trades that happen on these exchanges, how to collect that and how to create data. And it's about ease of transactions. And what ICE has done quite ambitiously relative to other exchanges is to go, okay, can we apply this to another very, very large financial market, which is mortgages? So they've gone in, they've acquired a few select technology businesses. They've spent somewhere in the region of $25 billion acquiring these, Black Knight being the latest example, which I think they paid $13 billion for. And so the idea is, can we put all of this technology together and create essentially one data chain for the entire mortgage process, from origination to servicing to all kinds of other parts of the mortgage process, effectively making it like a financial instrument, which is a really interesting strategy.
That is interesting. All right, so let's get to the second thing here. Finance increasingly moving on exchange. Talk to us about what you mean by that.
Yeah, so if you think about how the world looked maybe 30 or 40 years ago, a lot of financial transactions were happening on paper, over the phone, and what's happening is a lot of this was quite risky, right? And we saw with the financial crisis and all of these things, we need to centralize where these transactions are happening, we need to clear them, we need to create risk parameters around them, and exchanges are a perfect place for that. And so what you see is more and more financial transactions are being moved onto exchange. I mean, even the rise of Bitcoin, cryptocurrencies, this very similar sort of thing. Can we centralize it? Can we really get more and more information out of these trades, which helps regulators, helps users, decreases costs, decreases friction, and creates data businesses for these companies.
And for people who don't know, ICE owns the New York Stock Exchange, but it also owns a number of other exchanges, and not just stock exchanges, for other types of financial instruments, to your point.
Yeah, so they're big in interest rate derivatives, and they're big in energy. They own the Brent complex, so everything that's traded in terms of Brent and oil, so they have huge commodity businesses. They're also really big in carbon, so they're running the carbon emissions markets in Europe and also in the United States. And it's really one of their biggest and core franchises. There's also trading of fixed income and other areas as well.
And then finally, as well, it's a founder-led business. Jeffrey Sprecher is the guy who started it, leads the business still.
Yeah, I mean, it's a fascinating history of how he set up this business. And really, it was a brilliant idea and insight, and he's still leading the business today. That's quite rare in some of these large financial businesses. MSCI is another example of that, where you have
active brokers as well. I
yeah,
believe.
Exactly. And so you have founders in some of these financial businesses, and they're really still driven in building this. And that's why he's prepared to take this risk, what he's doing in the mortgage market, so do something different to create a lot of value for shareholders, which he's done in the past already.
So when we talk about these, we always like to mention what the downside risk could be. And in this case, post-deal leverage. As you said, they've made a lot of acquisitions.
Yeah, so the Black Knight was the latest acquisition. The balance sheet's a bit more levered than the classic exchange. These are cash machines, though, so over time they'll surely delever and maybe start buybacks or other ways of returning money to shareholders. They need to invest in these businesses as well, because it's a difficult transition technology-wise. But over time, that's what we think will happen. But leverage is always a bit of a risk, right? Things can go wrong, and so you have to watch that as an equity investor.
And just quickly, do you have a position in ICE?
We do, yeah. So we own ICE in our fund, which is focused on monopolistic businesses. And this is a perfect monopoly. It's all about network effects. The more people trade on each side, liquidity begets more liquidity and creates strength for ICE as a business.
Gotcha. Interesting. So let's get to the stock that you do not like, and that is the owner of the Hong Kong Exchange. And those shares have fallen quite a bit over the past year or so. So let's get to why you don't like it. First of all, you're looking at the valuation, and I believe you're valuing it enterprise value to EBITDA, if I'm not mistaken.
To EBIT is the way probably we look at that. But I think the key thing is the enterprise value, which often is miscalculated. If you look at services like Bloomberg, actually the way they put EV onto the screen is not as good as if you do it yourself. And if you do that, you find that ICE actually, despite the fall in the share price, is quite, Hong Kong Stock Exchange, despite the fall in share price, is actually quite an expensive share. And this is really strange given the growth profile of the business.
Interesting. Okay, so let's get to our next point, which is you think the growth that they have had is hard to sustain.
Yeah, look, I think there's no secret here, right? That effectively what's happening is mainland Chinese investors are preferring the A-share market in mainland China, and foreign investors are actually shunning shares. I mean, we see one of the most successful ETF stories is the emerging markets ex-China ETF. And I think there's a bit of a move away by foreign investors from Chinese capital markets. And really the people that feel the biggest brunt are the exchanges, like the Hong Kong Stock Exchange. And that network effect that I was talking about, it's really powerful on the way up, but it's also really powerful on the way down. It can really tear a monopoly apart. And that's why we think that the growth can't be sustained of this business.
And similarly here, losing market share, because when we tend to talk about the Hong Kong Stock Exchange here in the US in our coverage is when a company's deciding where to list, for example, and they're making the choice of some place like Hong Kong or London or the US. And so they're losing share that way, I assume, in terms of also trading share.
Yeah, so look, as you probably remember a couple of years ago, it was really popular for European businesses to list. So we're talking about Prada, Samsonite, L'Occitane. And now you read the rhetoric from these companies and they're all saying, actually, we'd rather delist from Hong Kong. The theory before was these are consumer businesses, the biggest consumer markets in the world, the growing ones are in Asia, we should be closer and listed there. But actually what they found is their share prices are trading at big discounts to their peers in Europe, and especially to the ones in the United States. This is really bad. We've seen this with the London Stock Exchange. It's really a game of where you can get the best valuation as a company. And I'm not sure if you're in a boardroom deciding where you're going to list, the Hong Kong Stock Exchange is going to be the place you're going to pick.
Interesting. Well, just as we talked about what could go wrong for ICE, let's talk about what could go right for this, and that's a cut in the stamp duty. Again, not something we talk about that often here.
Yeah, look, so exchanges, their lifeblood is trading, right? So the more trading that happens, the more money they make effectively. And there's ways of incentivizing trading, and one of them is stamp duty. In lots of countries around the world, you pay a bit of a tax to the government for trading shares or trading financial instruments. And what's happening in Hong Kong is there's going to be a cut in that stamp duty, which might incentivize trading by brokers, but also by local residents. Look, this is quite well telegraphed. It's definitely a risk. It could drive trading up and improve some of the numbers. But beyond that, it's hard to see what growth happens in this stock and this company.
And just quickly, what if there was also more of a rebound in the Chinese economy and Chinese stocks came more back into vogue? Would Hong Kong Exchange also get some of the halo effect of that?
Yeah, absolutely. That is definitely another risk, right? So as you can see, the share price has been under pressure. It's hard to see how that happens necessarily in the financial markets. I think it will happen in consumer markets and other areas like real estate. But yeah, you could see a sentiment-led bounce in the stock. And that probably would be a great time to, load up a short, if you will.
And do you have any position in this one?
We don't, no.
Okay, so let's summarize what you're telling investors here. Buy Intercontinental Exchange, also known as ICE, as it tries to do something different, entering the mortgage market, expanding there, and also finance increasingly moving into exchanges. On the other side, stay away from Hong Kong Stock Exchange, highly valued, might have a hard time sustaining that growth, and it's also losing market share in listings. Thanks so much, Yuri. Really appreciate you being here.
Thank you very much.
And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.